The Johannesburg Stock Exchange and the rand remain under pressure on the back of oil prices extending losses due to the weak demand in China. Let's get you some analysis on the various issues. Gary Booysen is the Rand Swiss portfolio manager, and he joins us via our video link. Gary, it's great to see you. Thanks for coming on. What's moving the markets today?
So I think a little bit of this is interest rate expectations, as always. We had the big U.S. non-farm payroll numbers last week, and they were much stronger than everyone had expected. So looking at adding 275,000 jobs, the expectation was for around 200,000. And that just means that the U.S. economy and the U.S. labor market is still very, very strong. We also have the U.S. CPI number out tomorrow. So I think a lot of people just treading water. They want to see what that inflation print looks like. If inflation is moderating, and the labor market is still strong, not such an issue. We can still expect some rate cuts coming through, and then maybe we'll see a little bit of a rebound. But as it is today, it's pretty red. We've got the all-share index down around 0.6%. It's really being led lower by the resources, which are down almost 2%. Industrials are faring a little bit better, down around 0.1%, as well as the financial index also down by around a similar margin. The currency, however, specifically to the rand dollar pair, is a lot stronger. So we're around 1868 at the moment, which is well off those lows of around, well above 19. So the rand looking a little bit stronger, which is good news for some, bad news for others. And as you say, Brent crude oil price also ticking up slightly. So a little bit of those geopolitical tensions, I think, around the Middle East still factoring into investor sentiment.
Yeah, absolutely. We saw this in the industry over the past few weeks. The FNB BER Building Confidence Index falling in the first quarter of the year. 4 out of 6 sectors surveyed declining. What factors are weighing on growth? And it seems obviously to be going from what was a bad situation not too long ago to much worse.
Yeah, it is, but it also looks like the fourth quarter figures were a little bit of an outlier. So we were in at 43, so 43 is still negative. 50 is around your neutral level, but that was an 8-year high. And this now declining significantly, so more in line with what we saw in the third quarter of 2023. And as you say, really across the board, this is a building confidence index. So you've got the likes of, building material manufacturing down 29 points, architects down around 25 points, hardware retailers down around 25 points, building subcontractors also down about 25 points. So big shifts in those 4 underlying indices. And the 2 that you mentioned that actually rose were main contractors and quantity surveyors, but they only rose by 1 point and 4 points respectively. So that overall index falling dramatically. And you can understand it. We're in a very high interest rate environment. It's difficult to see where, infrastructure spending is going to come from. So I think the built environment is a difficult place to be operating. People don't have money, and the cost of these big projects that really will help them is expensive, because the price of money with high interest rates is excessive.
Yeah, absolutely. Gary, banks are stepping in to give Pick n Pay a lifeline. What sort of negotiations are we seeing there?
Well, so Pick n Pay is in all sorts of trouble at the moment. They've had a big management change up at the top. They've also invested heavily in their clothing business and ASAP, and that's required a big escalation of debt. And it comes back to interest rates once again. When you're in a high interest rate environment and you suddenly have these big debt payments that you've got to make, it starts to really affect the operations of the business. So this is part of like an ongoing restructuring plan. They're planning on listing Boxer, which is one of their standout businesses, as a separate listing. And really what the banks are doing here is they're stepping in and they're just renegotiating the terms slightly to give the business a little bit more time before the listing. Because remember, we have, functioning capital markets in South Africa. So, if you need to raise capital, you can come to, the public market. You can, issue shares in a new Boxer IPO, and you can raise capital. And that's a wonderful thing. It's a very positive thing. And it is that will help Pick n Pay function more effectively as a business. Yeah.
Metair expecting to return to profitability in the year ending December. What is, excuse the pun, fueling this optimism?
So looking at Metair, yes, they're definitely saying just a trading update, and the market's loving it at the moment. So it is quite a thin stock. I remember trading it years ago, trying to get a big order in and out. It is quite difficult, but there has been around 2 million shares traded today, and the stock is up 22%. So definitely people taking heart from this. As I said, it was just a trading update saying that they're going to see double-digit revenue growth, and I think they're operating in a difficult environment. So if you look at Mutlaku, which is battery business out of Turkey. They had a shortage of contract workers. They've had all sorts of negotiations. They've also been affected by the infrastructure problems in South Africa, specifically, just with the export side of the business. Port and rail is always, difficult. They've been using, emergency air freight to move product around as well. So I think it's been a very difficult period, for the company, and specifically when you're dealing with someone like, in the EU and Turkey, which also has all the geopolitical risks as well. I think it's been very difficult, but a very optimistic update if you look at the underlying figures. At the same time, not totally optimistic, because their financing costs, again, it comes down to interest rates. Financing costs have increased by 90%. In the period. So, I think, difficult environment, but Metair managing to navigate it fairly well, and that's where the market's taking heart.
Yeah. Weak consumer demand, but still RFG Holdings seeing a jump of 5% in revenue. Talk us through those results.
So a jump of 5% in revenue is great, but it's not great when that revenue is coming from price inflation. So if you look in the South African business, specifically, so what they call the regional business, revenue up 6.7%, but inflation at 10.8%. Good for the business because they're managing to push through some of those increased input costs, but bad for us as consumers because all the Rose Food Group products are going to be that much more expensive for us to consume. At the group level, as you said, 5.1% jump in revenue, but selling price inflation up by 7.9%. So it's just telling you the story of volumes. That they might be getting more for their goods, but they're selling less of them as well. The international sphere, that was actually, the revenue was actually down 3.7%. And again, this comes back to ports and infrastructure. They have been unable to sell in the international market just because they can't get their goods to it. And that's a very, I suppose, sad reflection of our infrastructure. But at the same time, it hasn't just been our infrastructure that's been the problem. They've also struggled to push through price increases overseas. So they haven't managed to, maybe the international consumers are a little bit more wary, under a little bit more pressure. Can you imagine it than South Africans?
I really can't. Gary Booysen, let me thank you for your time this afternoon. He is the portfolio manager at Rand Swift, giving us the latest market moves.